Hey there, Iggy the Investing Iguana here, coming to you from sunny Singapore. Today, we're diving into the fascinating world of T-bills and exploring why the latest 6-month T-bill yield has taken a dip. If you're wondering what this means for your investments and how to navigate the current market landscape, stick around, I've got you covered. In this video, I'll break down the key takeaways from the recent T-bill auction results, explain the factors driving the yield decline, and share some savvy strategies for optimizing your investment portfolio in light of these changes. Whether you're a seasoned investor or just starting out, this video is packed with valuable insights that you won't want to miss. So, let's get started. Understanding the T-bill yield decline. So, what exactly happened with the latest T-bill auction? On July 18th, the cutoff yield for the 6-month Singapore T-bill fell to 3.64%, down from 3.7% in the previous auction. That's quite a significant drop, especially considering it was at 3.76 CK in early June. Now, you might be thinking, Iggy, why should I care about this? Well, my financially savvy friends, T-bills are a great way to park your cash and earn some interest while you're at it. When yields go down, it means you might not be getting as much bang for your buck. Strong demand, lower yields. The recent T-bill auction in Singapore saw a notable trend. Despite lower yields, investor demand remained robust. The total amount of applications reached 15.7 billion Singapore dollars, indicating continued interest in T-bills. Competitive bids also surged, reaching 12.4 billion Singapore dollars. This suggests that investors are still keen on T-bills, even with the reduced returns. Now, let's explore the yield data. The median yield of bids stood at 3.5%, while the average yield was 2.97%. Interestingly, both figures were higher than those from the previous auction. Here's what this tells us. 1. Fewer low-yield bids. While there were fewer bids at very low yields, the overall demand remained strong. Investors seem willing to accept slightly lower returns. 2. Mid-range bids. A significant number of bids fell within the range of 3.50% to 3.64%. This suggests that investors are striking a balance between risk and reward. In summary, despite the challenging yield environment, the T-bill market in Singapore continues to attract investor interest. What's behind the yield drop? The decrease in T-bill yields aligns with a broader trend of falling global bond yields. Here's what's contributing to this phenomenon. 1. Weak U.S. retail sales and inflation data. The United States has witnessed lackluster retail sales and softer inflation figures. As a result, investors are increasingly confident that the Federal Reserve, Fed, will implement rate cuts in September. This expectation has a ripple effect on global markets, including Singapore. 2. Trickle-down effect. Sentiments from the U.S. market often influence other economies. When investors anticipate rate cuts by the Fed, they adjust their strategies globally. Singapore, being a financial hub, is not immune to these shifts. 3. Interest rate cut momentum. Experts predict that interest rate cuts are gaining momentum in 2024. The focus has shifted from combating inflation to preventing job losses and potential recession. This shift in priorities impacts bond markets, including T-bills. What does this mean for you? Let's dive into what really matters, your money. With the T-bill yield falling, the gap between it and the best 6-month fixed deposit rates, which hover around 3.4% per annum, is narrowing. As an astute investor, this is your cue to explore other options to maximize your returns. Consider alternatives like Tiger Broker's interest bonus coupon, offering an attractive 6.8% per annum through Tiger Vault, or Moomoo Singapore's guaranteed 6.8% per annum return with Moomoo Cash Plus. Additionally, Syfe Cash Plus Guaranteed provides a secure 3.7% per annum return for a 3-month term, offering a stable and short-term investment option. Moreover, the recent launch of the Astrea 8 private equity (PE) bonds has caught the attention of many investors. The Astrea 8 Class A1 bonds offer a fixed interest rate of 4.35% per annum, while the Class A2 bonds provide an enticing 6.35% per annum. These bonds present a promising opportunity to diversify your portfolio and potentially increase your returns. So, keep an eye on these options to ensure your investments are working as hard as possible for you. Market movements and updates. In recent market developments, both U.S. and Singapore stocks have continued their upward trend, fueled by growing optimism about potential interest rate cuts. This positive sentiment has particularly benefited real estate investment trusts, REITs, with notable gains observed in Keppel DC REITs, which rose by 9.9%, Mapletree Pan Asia Commercial Trust, which saw an 8.9% increase, and Suntech REITs, which gained 8.4%. Focusing on Keppel DC REITs, the company has made a strategic move by agreeing to acquire a shell and core data center in Tokyo for 201 million Singapore dollars. This acquisition represents their first foray into the Japanese market. The transaction, once finalized, is anticipated to enhance the distribution per unit, DPU, by 1.1%. This is certainly encouraging news for investors, as it signifies potential for increased returns and further diversification of Keppel DC REIT's portfolio. Such strategic expansions and market movements highlight the dynamic nature of the investment landscape, offering both opportunities and insights for savvy investors. Phew, that was a lot of ground to cover. But I hope this video has given you a clearer picture of the current T-bill yield situation and how to navigate the ever-changing investment landscape. Remember, staying informed and adaptable is key to making the most of your money. If you found this video helpful, be sure to smash that like button and subscribe to the Investing Iguana for more financial wisdom, tailored just for you. I'd love to hear your thoughts and questions in the comments below. Let's keep the conversation going. And if you're hungry for even more investment insights, head on over to our website or check out our other videos. Until next time, stay savvy and keep investing like an iguana.